Silver just tagged $97. Not $97 someday. Not $97 if inflation goes crazy. I mean, right now on the screen in real time, $97 an ounce. And that number matters for one reason. This isn't a normal rally. This is a structural re-rating. The silver market as we knew it is dead. What we're seeing at $97 isn't a bubble. It's a physical breakdown of the global supply chain. And if you're wondering why everyone is whispering 100 like it's a launch code, it's because $100 is not a price target anymore. It's a trigger. Welcome back. I'm going to walk you through what just happened, why this move is different from every silver spike you've seen in the last decade, and what the next 72 hours could look like as the market collides with the $100 psychological wall. No hype, no conspiracy fog, just mechanics, official reality, and the brutal math of a commodity that the modern world cannot function without. The $97 print is a message. Let's start with the first data point that should punch you in the chest. Silver is up nearly 230% from its early 2025 lows around $28. Read that again, 230%. And on January 19, 2026, silver delivered a 6.3% single-day jump, outperforming almost every major asset class in a single session. That's not healthy bull market drift. That's a market repricing itself under pressure. Here's what a structural re-rating means in plain language. The world is not bidding silver higher because it feels like it. The world is bidding silver higher because it has to. Because the old silver market was a speculative toy. The new silver market is industrial oxygen. The perfect storm, 5 years of deficits. Now we zoom out. This isn't about one day's candles. It's about the inventory story underneath the chart. 2026 marks the 5th consecutive year of a structural silver deficit. Deficit means demand exceeds supply, not on paper, in metal. And since 2019, over 1 billion ounces have been drained from global available mobile stocks, the stuff that actually moves through vault systems in places like London and New York. Think about the scale. 1 billion ounces isn't a headline number. It's a decade of buffer. It's the shock absorber that keeps spikes from turning into shortages. When that buffer gets thin, the market stops behaving like a market. It behaves like a fire. Because every buyer realizes the same thing at the same time. If you don't secure your supply, you don't ship your product. If you don't ship your product, you don't exist. The deficit math nobody wants to do. When I say structural deficit, I don't mean a cute chart in a research PDF. A deficit is a hole, and every year the hole gets filled by one thing only, above ground inventory. That means the market is eating the pantry. Picture global silver stockpiles like a city's water tower. You can run a water tower down for a while and nobody notices. The taps still work, the showers still run, the headlines stay quiet. But the moment the water tower drops below a critical level, everything changes. Pressure drops, rationing begins, and the price of water is no longer set by supply curves. It's set by panic. That's why the phrase mobile stocks matters. Mobile means available, deliverable, transferable, not locked away in a museum, not embedded in electronics, not sitting in a vault that has already been spoken for. So when over 1 billion ounces get drained from the mobile pile since 2019, what's left is a thinner and thinner cushion. And in commodities, thin cushions create violent candles. China just pulled the export brake. Here's the second engine in this rocket ship, and it's the one most people still don't understand. As of January 1st, 2026, China, the country that processes roughly 60-70% of global silver, implemented a strict export licensing system. Only firms producing 80-plus tons annually can export. That sounds bureaucratic. It sounds boring. It sounds like trade paperwork. But in commodity reality, that's a choke point. That's a supply gate. That's a valve on the world's most important conductive metal. And when you gate supply, you don't just change price. You change behavior, because manufacturers don't wait for spot. They lock contracts. They pay premiums. They hoard. They pull forward inventory like their life depends on it, because it does. Industrial panic, AI, solar, EVs. Now let's talk about the demand that's rewriting the silver story. AI and data centers are not just electricity hogs, they are metal hogs. In 2025, US and China data centers alone consumed an estimated 350 million ounces of silver. That's more than half of total global mine supply. Let that sink in. One sector, compute, pulling more than 50% of the mine stream. Then you add the solar floor. Global solar capacity is projected to reach 665 gigawatts in 2026, and solar panels now consume nearly 25% of the world's annual silver supply. Solar isn't optional anymore. It's policy. It's grid planning. It's national strategy, meaning this demand doesn't disappear because the price is higher. It keeps coming. Then EV intensity. Electric vehicle production is projected around 15 million units this year, requiring roughly 70 to 75 million ounces of silver. Silver is the conductive glue of the green energy transition. It's not a luxury metal, it's a required input. So when people ask, why is silver moving like this? The answer is because silver is no longer a trade. It's a bottleneck. Why industrial buyers don't care about your chart? Retail traders stare at a chart and ask, is this overextended? Industrial buyers stare at a production schedule and ask, will we be shut down? These are different universes. If you're running a data center build-out, you don't get to pause because silver is expensive. If you're rolling out solar at national scale, you don't get to wait for a pullback. If you're building EV supply chains, you don't get to miss delivery windows. So you do what big buyers always do in a tightening market. You bid early, you sign longer, you pay up for certainty. This is the part where the financial world gets confused because they're used to a world where higher prices destroy demand. In silver's new reality, higher prices can actually pull demand forward because everyone tries to secure supply before the next price jump. That's how demand destruction turns into demand acceleration. The paper market is cracking. Lease rates. Okay, now we reach the part where the invisible plumbing becomes visible. 1 month silver lease rates, the cost to borrow physical silver, recently spiked above 30%, with overnight costs reportedly hitting 100%. This is a classic stress signal because lease rates don't explode when everything is fine. Lease rates explode when someone needs metal now, not a promise, not a futures contract. Metal. Imagine you run a factory and you're short a key component. You don't care what it costs next month. You care what it costs tonight because your assembly line starts at 6 a.m. That's what lease rates are screaming. Immediate physical demand is colliding with limited immediate physical availability, and that is how a price spike becomes a supply event. The hidden weapon, options and gamma. Let me give you one more layer that explains why round numbers like $100 can move like a trapdoor. Options. When price approaches a major strike level, you often get concentrated open interest, meaning a lot of contracts cluster around that strike. If the market pushes through it, dealers who are short calls can be forced to hedge by buying the underlying. That hedging can create an ugly feedback loop. Price rises, hedges buy, price rises more. This is why a breakout can go from gradual to vertical. And it's also why the defense at $100 can be savage, because the same forces that create the breakout can also create the whipsaw, shaking out anyone who can't survive volatility. So if you see wild candles near $100, don't be surprised. That's the market burning off positioning. $100 is a psychological wall and a machine trigger. Now we address the big number everyone is staring at, $100. Here's the truth. $100 is not mystical. It's mechanical. It's a round number. It sits on every chart. It sits in every headline. It sits in every algorithm. And we are now in a market where algorithms matter more than opinions. Because as the gold to silver ratio compresses toward 51, down from 100 plus 1 in 2025, silver moves faster than gold. Silver is the smaller market. Smaller markets move violently when big money rotates. And when silver approaches $100, you get a chain reaction. Automated breakout buying stops getting hit on the short side, margin pressure on levered positions, forced covering, then a sprint, not a climb. This is why analysts believe the move from $97 to $100 could be the fastest $3 move in history, not because people suddenly believe, because the structure of the market forces speed. Old silver versus new silver, the visual you need. If you want a simple framework, hold this comparison in your head. Old silver market, pre-2025. Primary use, speculative, charged investment driven. Supply, open global trade. Inventory, sufficient buffer stocks. Gold to silver ratio, 81 to 101. New silver market, 2026. Primary use, industrial. AI plus, green tech, now dominant. Supply, restricted trade and gated exports. Inventory, decade-low vault levels. Gold to silver ratio, near 50.1 and dropping. That's the structural re-rating in one snapshot. We didn't just get a new price, we got a new market. 2011 was a spike. 2026 is a rewrite. A lot of people will say, silver has done this before. Remember 2011? Yes, I remember. But 2011 was a spike driven by money chasing momentum. 2026 is a rewrite driven by industry chasing material. Back then, the story was mostly investment fever. Today, the story is embedded demand. Back then, supply chains were open. Today, supply chains are gated. Back then, inventory buffers were healthier. Today, the buffers are thin, and the cost of borrowing metal is screaming it. Same metal, different era. Who's panicking? Banks, shorts, and the reality check. Now, let's address the part that people always argue about, the shorts. Yes, banks are scrambling. Yes, short sellers are being liquidated. And yes, For the first time in modern history, paper silver is being forced to face the reality of empty-feeling vaults. But I want to be careful with language here. This isn't about a secret cabal pushing a button. This is about incentive structures. If a market has more claims than deliverable supply, the weakest hands get flushed first. If funding costs explode, leverage collapses. If margins rise, the crowd gets pushed out. This is how markets enforce physics without ever admitting anything. And right now, silver is enforcing physics. What happens next? The three-stage launch sequence. So what happens now? I see 3 stages, and you need to recognize them in real time. Stage 1, the approach. This is where we are, $97. Volatility rising, headlines everywhere, people waking up late. Stage 2, the trigger. This is the $100 zone. Expect a battle. Not because $100 is special, because positioning is special. Breakout buyers collide with defensive shorts. Machines collide with humans. Stage 3, the afterburn. If $100 breaks cleanly and holds, the narrative changes overnight. Mainstream coverage goes from speculative surge to industrial shortage risk. That's when procurement desks start paying almost any price to avoid being the manager who ran out of metal. The 2 outcomes after $100. Let's be honest about the fork in the road, because markets love to punish certainty. Outcome. A, the break and run. Price hits $100, clears it, and doesn't look back. That's when the headlines switch from silver rally to silver shortage, and the public stampede begins. Outcome B, the wall and whip price hits $100, gets slapped down and prints chaos, a nasty shakeout that convinces weak hands it's over, right before the next leg higher. Both outcomes can still be bullish. One is fast, one is cruel. So your job is not to predict the exact candle. Your job is to understand the forces so you don't get emotionally hijacked by the candle. Your battle plan. Watch these 5 signals. I'm not giving you financial advice. I'm giving you a framework. If you want to know whether this move is real, watch 5 things. Lease rates. Do they stay elevated or snap back? Physical premiums. Are coins and bars disconnecting from spot? Delivery chatter. Are more contracts standing for delivery? Vault tone. Do reports talk like inventory is available or tight? The ratio. Does gold to silver keep compressing or stall? These signals tell you whether we're in a normal rally or a supply event that the chart cannot fully explain. What not to do. 2 quick warnings, because this is where people blow themselves up. First, don't confuse volatility with invalidation. In a structurally tight commodity, volatility is normal. It's the mechanism of rationing. Second, don't let headlines trade you. The market can gap $2, $3, $5 on a rumor in a thin moment and then reverse. If your plan is react to the last notification, you will be the exit liquidity. You need a framework, you need signals, you need patience, because in this kind of market, the crowd pays tuition. So yes, silver just hit $97, but the real story isn't 97s. The real story is that the world quietly crossed a line where silver stopped being a bet and became a necessity. Elon Musk needs it. The AI revolution requires it. Solar demands it. And China just tightened the gate. That's why $100 feels like a rocket ship launch. One more thing, this isn't about being right. It's about being prepared. In a re-rating, the market moves first. Explanations arrive later. Stay sharp. No hero trades. If you want, comment one word. 1. Rocket. If you think $100 breaks fast, or wall if you think $100 becomes a battlefield.